This is the third and final one of Beck2's tax talks. From the first talk, we hope that you're now clear about how tax works and why it's so complicated. From the second one, we hope you've got a clearer picture of how people in conventional PAYE employment pay taxes, the mechanisms and how much. Once you know these things, it becomes a lot easier to understand the things that most freelancers really want to know. For instance, what kind of taxes does a self-employed sole trader pay? And how is that different to someone who's trading through their own limited company? What are the relative advantages and disadvantages? Once you understand those things, it becomes a lot easier to understand what the whole freelance deal is. Taxes are important, and by the end of this talk, you'll be in a good position to understand how much you get to keep when you work through different structures. Because you may even be worse off financially by not working through PAYE. But if that's not the case, hopefully you'll be able to see whether the advantages are a good trade-off, because the self-employed do have different employment rights and welfare rights to someone on PAYE. And you could say that people on PAYE have better employment and welfare rights generally. So let's look at the question of freelancing. Beck2 has tens of thousands of members who describe themselves as freelancers. And we have to ask ourselves, is the word even a useful one? In a very legal sense, freelancers don't really exist. There are people who describe themselves as freelancers, but they work through a tax status of either PAYE, self-employed sole traders, or even people who trade through their own personal service company, a limited company. You'll have heard the term PAYE freelancer. There's also the rights that people have in relation to their employers or their engagers. 3 different freelancers could be working with different sets of employment rights. You could have the rights of an employee. You could have the rights of a worker who has fewer employment rights than an employee. Or again, there's someone who's self-employed who has fewer rights again. If you work through your own limited company, any employment rights you have, you can only exercise against your employer, and that's you. And then there's a very important and very undervalued rights that workers have to receive pension contributions from their employers. Some people who call themselves freelancers qualify for a pension auto-enrolment and some don't. Beck2 provides information about freelance pensions for members, but we won't be dealing with this here. So there's one of 2 answers to this question, is there such a thing as a freelancer? If you want to argue yes, I think you can. You could say that people who call themselves freelancers have a lot in common. They have unexpected periods of unemployment. They have a very thin safety net in times of difficulty, and only a technical right to employment protections that may not exist in reality, or rights that are impossible to exercise due to qualifying periods, for instance parental rights or the right to challenge an unfair dismissal. There's no guarantee of job security, particularly for people taking parenting breaks. They can't expect a job to be waiting when they return to work. It's the common experience of insecurity. They have less predictable working hours and terms. It means that they have problems making childcare arrangements. A full family life is often harder to manage for freelancers. They also struggle to get mortgages and even rental agreements because of their insecure employment outlook. And then there's all the admin. You have to do your own tax return. You have to issue invoices and then chase them. If you trade through a limited company, you'll even have to prepare company accounts or pay an accountant to do so. And it's all a learning curve. It may be quite intimidating. Not only that, there's also the auto bit in pension auto-enrolment. In recent years, we've seen that PAYE employees have started saving for their retirement again. 10 or 15 years ago, governments were very worried about a thing they called the pension black hole. They're not so worried now, but for freelancers, the forecasts have actually got worse, because freelancers have to make a conscious decision to save, and many just don't do so. So governments have a freelance pensions tax bomb on their hands. Let's hope government will start to focus on that soon. Many freelancers have very low pension savings, and this must be a worry to them. But let's not get overwhelmed with all the downsides. There are lots of upsides to freelancing, if you can get it to work for you. You're not tied down. You choose when you're going to work, for who, and for how much. Freelancers share a greater sense of control over their own circumstances. But anyone who's watched the way the recent pandemic was played out, or the way the film industry downturn related to the writers and actors strikes in the United States, they'll tell you that all of this gets tested in tough times. So in conclusion, freelancers do exist. They are a distinct, identifiable group of people with lots of common concerns, even if they don't necessarily have a particularly solid and easily defined legal status. So now let's look at the difference between being PAYE and doing self-assessment and being self-employed. There are three main ways that freelancers I've spoken to can pay taxes. For those not on PAYE, deductions are not taken directly from income. Instead, they're paid as a result of a self-assessment process. Now, there's a big change called Making Tax Digital that's coming. It will result in more regular incremental tax payments than many sole traders are used to. The upside is you may find that your taxation is a lot less clunky, a lot less time consuming, and a lot less bureaucratic. There are slightly different rates that the self-employed pay, particularly national insurance. You pay a slightly lower rate of national insurance than someone who's PAYE. The employer national insurance contributions that we looked at in the previous talk are not generally paid by people who employ sole traders. So that's a difference. For one form of self-employment, trading through a limited company, income tax and national insurance contributions are usually a lot lower, but other taxes are paid instead, as we're going to see in a few minutes. So when you're self-employed, you don't pay tax on your income, you pay tax on your profits. So that's the amount of money you've received minus some legitimate business expenses that you've incurred in earning that money. These are called allowable expenses, and they're money that you've spent wholly and exclusively to earn the profits. They might include travel expenses sometimes, overnight accommodation away from your normal base, accountancy and legal fees, insurance, and there's lots of other business costs. You can sometimes even treat a room in your own house as a business expense. Do look into this in a bit more detail. Make sure you do a bit of research around this and understand exactly what you can and can't claim, because you can't claim for all expenses. Do you remember that previous talk when we saw how complicated tax can get? The short version of this is that the self-employed pay a bit less in national insurance. It's important that you do pay national insurance contributions though. It influences things like your state pension entitlement. Now look, the rest of this slide is really boring. Unless you're earning less than £12,000 a year, there's nothing more that you need to know from this slide. If you're not a low earner or someone with a very academic interest in this, you might want to fast forward to the next slide. If you're still here and want to know the details, then firstly, there are your Class 2 national insurance contributions. They're payable up until you reach state pension age. And you need to have 35 qualifying years paying some kind of national insurance contributions to qualify for the full state pension. These contributions also determine how much of other benefits you're entitled to. So benefits like maternity allowance, bereavement benefit. However, it doesn't count towards things like job seekers allowance or statutory sick pay. If you're not paying national insurance contributions through any PAYE scheme, then Class 2 national insurance contributions are important. Very low earners need to know that if you earn between £6,725 and £12,570, you are deemed to have made Class 2 national insurance contributions without actually having to pay them. That's a recent change. Very, very low earners, people earning less than £6,725 a year, have an option to pay £3.45 a week in voluntary contributions. And we would recommend that everybody with less than 35 qualifying years should already think about this and should be paying it. For everyone else, Class 2 national insurance contributions are a simple flat rate payment of £3.45 a week. There. Are you glad you stayed for that? We can also skip over this slide quite quickly too, because you've probably seen it before and you can see from the detail it's the same as the one shown in previous talks on PAYE taxes. If you're self-employed, you pay exactly these income taxes as someone on PAYE. The one big difference is that, like national insurance contributions on the last slide, you pay from your profits and not your income. So there are some expenses you can claim back. But apart from that, it's the same. Okay, now this is the bit I hope you've all been waiting for. Let's compare self-employment with PAYE to see how the deal is different. And to illustrate this, we're going to play a bit of a game. Let's imagine we're playing a board game of some kind. Imagine that there are a number of players, each of whom want to get a lot of money and spend as little as possible doing so. So the players are, firstly, there's the workers. That's probably you. Then there are the employers. And the employers want to get lots of work out of you. They want to pay you the sort of wage that will get the best work out of you, but they don't want to spend any more than that if they can avoid it. If they can find a way of getting the work that they need done, they're going to try and avoid any other costs they can. Then there's the tax office. They want to get as much tax out of the whole deal as they can. And they want to do it in a way that doesn't result in lots of squeals. So they'll have lots of clever devices that people don't always notice. We went over this at length in the first tax talk. Next is your pension pot. You may not really be aware of this yet, but the closer to retirement you get, the more you will. It's very important that you feed this piggy bank. We're going to treat it as a player in this game too. Then lastly, there's the thing that makes the game work. If you're on PAYE, it's your pay slip that does the heavy lifting. If you're self-employed, it's up to you to manage a bank account that collects your money and pays your taxes and other things. So that's the game, and those are the players. So we'll start by looking at the PAYE employee scenario. This is the standard scenario that most people in work have, including many people who call themselves freelancers. So let's imagine you're an editor working for a post-production company. So there's the employer. And the employer will be buying the tools of the trade that you use to do your work. So I've used an example of a camera and a laptop here. And then there's you, the employee. And you have a pay slip. And it's the pay slip that decides where the money goes and divvies things up generally. So your employer is going to pay your gross pay into your pay slip. Your employer is also going to pay employers' national insurance contributions to the tax office. And they'll possibly pay an apprenticeship levy as well, not a small amount. And then your employer will pay employers' pension contributions into your pension. Your employer will also pay reasonable expenses. So if you have to travel for work, they might pay some mileage. They might pay for your accommodation if you're working away from home. They might pay for meals if you're working away from your normal workplace. Then there's your payslip, which pays your income tax and it pays your employee national insurance contributions. And it also pays your employee pension contributions. And only when all of that's happened does your payslip let you keep the rest. So that's your net pay. That's your take-home pay. There's a very low risk of a tax investigation. So an employer who doesn't want the tax office sniffing around too much will use this method of employing you. You have better employment rights, but you pay for your own community costs and your own lunch when you're at work. So let's look at the scoreboard. Employees do okay out of this. They don't have to fill their own tax returns in. HMRC get a good slice of your income as tax or national insurance contributions, and your pension pot is getting money from both your employer and from you in a very tax efficient way. The employer finds this quite an expensive way of employing you, and often if they can find a way of employing someone who'll do it self-employed, they may choose that option. So now let's look at the self-employed sole trader. So let's imagine a filmmaker working for different production companies. So let's look at this scenario. This time we're going to use a business bank account as the thing that does all of the heavy lifting. And there are your engagers now. We're going to call them engagers instead of employers. They're paying invoices. And your business bank account, which is you, has to buy your own tools of the trade. So there's a cost that's shifted away from the employers and onto you. So then there's the reasonable expenses. You'll have to pay them out of your bank account. You might find ways of adding something to the invoices so that your employers are going to cover the costs of these expenses, but fundamentally, the cost of those comes out of your business bank account. And I've added a fourth little icon there. You'll see a little building there. That means that you can sometimes pay for a room in your own house and treat that as a legitimate business expense. Do look into it in a bit more detail if you're planning to do it, but I'm just noting it here. So all that's happened, once all those expenses have been taken out, your trading profits go to you. And that's you, the self-employed sole trader, and you pay your own income tax, and you pay your own national insurance contributions. You do a tax return once a year for that, and you have the option to pay into your own pension. Whether you take that or not is up to you. The costs and liabilities are so much lower for the employer and the engager. They have to pay fewer national insurance contributions. They're not having to pay those employer national insurance contributions, and you save less in your pension pot. You have fewer employment rights. You still have to pay your own commuting costs, and you still have to buy your own lunch when you're at work. The risk of a tax investigation here is higher. HMRC don't like the fact that they're losing those employer national insurance contributions, and if they think that the employers are treating you as a self-employed sole trader when they should treat you as an employee, then they'll take action. So, in terms of the winners and losers on this one, the engager, or the employer, is a winner. The worker is to some extent as well. But the worker has downsides. They have fewer employment rights. HMRC are definitely getting less money. Your pension pot is probably not getting as many contributions and not in as tax efficient way. And the engager does lose something by not having people in employment. There are all sorts of business reasons why employers actually need workers who they can rely on to turn up all the time, people who they can train for specific purposes and things like that. So it's not all upside for the employer if you go self-employed. So finally, the most complicated one is where you're trading through your own limited company. I'm going to call this the personal service company scenario. So let's imagine you're a set decorator working for production companies. You've set up your own company. The official reason to trade through a limited company is to limit your liability in the event of something going wrong. If you trade through a limited company, your company will pay corporation tax on all profits at a rate of 19% as long as your company is earning less than £250,000 a year. Once you're over that mark, the marginal rate goes up to 25%. You, as the owner of the company, can draw income from that company in dividends. And this is where you draw down some of the profits from the company after the company's expenses have been taken into account and treat them as personal income. Now, HMRC have regarded this whole business of trading through a limited company as something that is open to abuse. They believe it's sometimes used as a way of avoiding taxes. So we've seen in successive budgets that the allowances have changed. It used to be the case that the first £5,000 that you drew down as a dividend was tax-free. And then you had to pay dividend taxes on that after that. In recent years, it went down to 2,000, and then more recently, it's gone down to 1,000. So anyone who's made calculations about trading as a limited company a few years ago needs to redo those calculations, bearing in mind the recent changes. So I've mentioned that you have to pay tax on dividends. Dividend taxes are complicated. I'm not going to be able to explain it very simply and concisely in a presentation like this. You don't pay tax on the first £1,000, but it does affect your wider tax situation as well. So really research this a bit more. If you're paying yourself a carefully chosen combination of income and dividends, it can significantly reduce your income tax and national insurance contributions. Some people don't pay any, but your company will have to pay corporation tax, and you as an individual, as I've said, will have to pay dividend tax. So this is the third scenario, the personal service company scenario. Again, there are players. In this case, it's your personal service company's company balance sheet. That is going to be buying the tools of the trade. So the costs are on you there. That will also pay for those reasonable expenses, including a room in your house, if you decide to do that. Your engagers, as ever, will be paying invoices, and they'll be paying it into your limited company. And your limited company will be paying wages to the worker owner, which is you. And you as the worker owner may pay some income tax, and you may pay some national insurance contributions. I've made those look quite greyed out there because often people who are worker owners of their own limited company pay very little or no national insurance contributions or income tax directly in that way. Your company will also have to pay corporation tax to HMRC, and I mentioned about that in a slide earlier as well. Your company will probably pay some pension contributions. If you've got a good accountant, they will advise you to do this if you can afford to do it. And any money that's left, only the money that's left after that, is the trading profit of the company. And that trading profit is issued as dividends to you, the worker owner. Once you've got that, you, the worker owner, then has to pay dividend taxes. And you may have to pay some national insurance contributions. But again, I've made that grey because often people structure it in such a way that they have to pay very little or none of that. Depending on your earnings, everybody's situation is slightly different. So I'm making generalisations here. You may want to pay an optional pension into your pension pot as well. If you can, you should do. You have fewer employment rights, and those that you have are only really exercisable against your own company. The worker owner still pays their own commuting costs. They're still paying for their own lunch when they're at work. The costs and liabilities, again, are so much lower to the employer or the engager. There's fewer or no national insurance contributions paid. Income tax isn't collected by the employers. They're usually not paying anything into your pension pot. The risk of a tax investigation is quite high here. HMRC are aware that people do this in order to avoid taxes. And anyone who's been following the whole question of IR35 will know about this. The liability for this has moved to the engagers and away from the person who's trading through their own limited company. Okay, so once again, there are winners and losers. The engagers are definitely the winners here. The worker has some advantages. They're paying fewer taxes in some respects. Accountants are definitely the winners here. There are losers as well. The workers have lots of additional duties. They have to fill out tax forms. They have to file company accounts. The pension pot may be losing out here. HMRC are definitely getting less money. And the engagers aren't having the advantages of having employees. We've said there are some financial disadvantages for having employees, but there are lots of business advantages. And lastly, as we're talking about freelancers, Beck2 advises thousands of freelancers each year. In our experience, freelancers often undervalue their employment rights. And we've seen during the pandemic that people realise that their employment rights are worth more than they realised. Freelancers often undervalue their pensions. There is a pensions black hole for freelancers, and we would urge every freelancer to take more advice than they're getting on pensions. Freelancers often undervalue a good accountant. Having the cheapest accountant may not always be the most cost-effective answer. A good accountant should be able to help you save money. Freelancers often undervalue how much they're giving to employers and engagers when they're not working PAYE. So we would always urge people to charge a little bit to employers to cover those advantages. And lastly, freelancers may undervalue how important it is to stick together. for better terms, better rates and better conditions. And that's what being in a union is all about. And that's the end of Bec2's self-employed tax talks. I hope this has been useful.